Hello everyone, I hope you're having a great week so far. My name is Drew, the host of Never Behind. During the last couple of months of 2023, we had a great bull rally where the S&P 500 went up approximately 15% and the Nasdaq around 25%. I'm sure many investors were enjoying the rally during this period, but on the other hand, there were also investors getting worried about the rally, saying that the market went too high too fast and has to have a major pullback. Now in the first couple of weeks of 2024, the market has shown a bit of a pullback but rebounded at the 9 SMA or the 9 simple moving average and is moving up again. Now a major question that many investors have is whether this bull rally is sustainable or will we have a major pullback. Now recently the chief investment strategist at JP Morgan, Thomas Kennedy, has shared how much money his clients have on the sideline that are ready to be invested in the market and shares his idea on what sector or categories of stocks the money may pile into, along with why he thinks the market will go even higher in 2024. So with that, let's see what Thomas has to say about the market this year. Now before getting into the interview, I just wanted to share that Moomoo is having a great promotion, giving out 15 free stocks, which I think no one should miss. So if you are interested in receiving the 15 free stocks, make sure you click the link in the description below. I've also started a Discord that is 100% free and have great experienced investors regarding stocks, options, swing trading, chart analysis, and also cryptocurrencies, sharing their ideas and opportunities for investments every day. So if you're interested in being a part of the community, please click the link Discord in the description below.
Does the market's recent weakness provide an opportunity for people to get more invested? Our next guest says most of his clients are still overweight cash and need to get back into the market. And he has some thoughts on exactly how to do so, both for stocks and bonds. For more, let's bring in Thomas Kennedy. He's the chief investment strategist at JP Morgan Private Bank. So your decisions, Tom, probably touch on what's going on with a lot of people's money these days. It's good to have you. Welcome.
Thanks for having me, Kelly.
And what would you say this boils down to? Trying to coax people out of cash still?
Our community, which is one of the biggest pools of wealth assets in the world, is still heavily overweight cash. So the rally that we saw in November and December has created a challenge for people to get reinvested. And we're calling it the everything rally. After the everything rally, what do? In November and December, you saw stocks and bonds outperform generally what you would have expected the S&P 500 to give you in an average year. So it is a challenge to get people over the hurdle. But I think there's opportunities in stocks and in bonds to really get there.
What are the best ways to do so, you think, as you look around the universe?
Relative to what's in the price, at the broad level, high level, I think the market has priced in a soft landing almost perfectly. If you and I were sitting here, Kelly, say 6 months ago, what should the market price for Fed cuts in a soft landing? I think the average person would say roughly 200 basis points over a year and a half. That's what the market has right now. So I think for the bond market, the easiest thing to say is rate cuts are coming and that cash yield is going to go down. I can move out the curve just a little bit and maybe lock in a 5% yield. I think that's the easiest trade to make. But really what we really need our clients to get to do is to get some more capital appreciation, be ready for the next bull market in equities.
Now I think Thomas has shared a number of great insights during this interview. So first of all, the majority of customers in one of the biggest pool of assets in the world are heavily overweight in cash. In other words, even after the massive rally that we have seen in the last couple of months in 2023, there is still a ton of cash on the sideline ready to be invested in the stock market. Therefore, if there is a major pullback in the market, this huge pile of cash will think of the pullback as a buy the dip opportunity and will come into the stock market, causing another rebound. Now, Thomas did also have a great point that since we had a major rally starting from October last year, investors that were on the side did not have many places to invest in, with the prices all going up, and therefore again are waiting for a pullback to invest their money in. I personally think that unless this pile of cash is mostly invested in the market, it would be very unlikely that we will have the market crash that many are expecting to happen in 2024 or 2025. Now on the second half of the interview, Thomas shares why he thinks the best opportunity may be to invest in 2024 and the reasons behind his thoughts. So let's see what he has to say about the market in 2024.
Yes, the S&P 500 is trading at PE multiples higher than historical averages, but small and mid-cap stocks trading relatively cheap, and that's where earnings growth should accelerate the most with a better economic backdrop for 2024.
Let me ask you one more about that, because that's a really interesting point. But I think a lot of people who are on the sidelines would think to themselves, okay, do I hold my nose and just kind of buy the S&P 500 even though it's gotten away from me because it's typically the outperformer? Or do I go for something where there's maybe a little bit more quote unquote value, but it might lag over time, which my sense is maybe that small and mid caps do, but maybe I'm wrong about that.
I think the historical backdrop, Kelly, important to recognize is small and mid-cap stocks tend to be the most sensitive to growth. And in the last 12 maybe even 18 months, interest rates have been the dominant driver. And as interest rates have come down, you've seen tech shares really snap back quickly. Price to earnings multiples on small and mid-cap stocks are cheap, one, maybe two turns cheap, depending on what you're looking at. But as growth accelerates or gets repositioned for higher expected earnings next year, we should see small and mid-caps outperform, at least tactically. The thing that's important for my clients is they're underweight this sector. If we do get that firm soft landing, which we're expecting in our baseline, small mid-cap should outperform better.
Now, the host made a great point where she mentioned that many investors may just want to invest in the S&P 500 since they typically grow 7 to 8% in average and don't have to worry that much about losing their money. But I think Thomas also shared a great insight on why he thinks the mid and small caps will give us a much greater return in investment compared to the S&P 500. As he was saying, the mid and small caps are very sensitive to the interest rates since they are still growing and may have a lot of debt and at the same time may not have a strong balance sheet. So if the Fed does lower the Fed fund rates in 2024 as low as many investors are anticipating, the mid caps, small caps, and the growth stocks will rebound pretty high pretty fast. He is also saying that the majority of his clients are underweight in the mid and small cap sector and are preparing their cash for an opportunity to get in this sector, which has a fairly low forward PE ratio compared to the big techs. So if the Fed does lower the Fed fund rates more than 3 times and the inflation keeps coming down with a strong labor market, the mid and small cap stocks might be a sector that you may want to keep an eye on. Of course, only time will tell, but the FOMC meeting on March, where most of the investors are anticipating the first Fed fund rate cut, will be a very important day for the market in 2024, in my opinion. So with that, I hope Thomas's insights gave you some ideas on how you may want to invest in 2024. So thank you very much for watching and hope to see you on my next video.